Hi, welcome to this podcast on investing. I'm going to talk a little bit about the difference between savings and investing, then give you some vocabulary and talk about different investing tools, or otherwise known as investment vehicles. So, the difference between saving and investing is that with saving, you have your money in a place that is easily accessible in the sense that you can convert that money into cash, like your savings account and your checking account. And the goal of savings is to make sure that you have money put aside for when you need it. And so it's going to keep you secure so that you don't go into debt. Whereas investing, while it can be in the short term, it's mostly long-term things where your hope is to make money. You're not trying to make money off of your savings. You're trying to make money off of your investments. And there's more risk, but there is the more possibility of gaining income and also increasing your net worth and being able to have that money and make your life more comfortable in the future. In general, investing is something of value that you're going to buy that provides you with money, but also comes with the risk of not making any money. So the hope is that over time you will make money, and a lot of investments do, but not always. Now, as I said, investments come with the chance of loss, which is known as risk. And we'll see that there is a relationship between the type of investment and how much risk you take. But it's important to know that savings vehicles don't come with the type of risk that investments do. Another important term is liquidity, and it's the idea of how quickly something can be converted into cash. Nowadays, we do use a lot of credit cards, but in general, the fact that sometimes you might need to write a check for something is essentially the same as that having been converted into cash. So savings accounts are a lot more liquid than investment accounts. Nowadays, it is easier to gain access to your investments and to sell those investments with apps, but traditionally investments are a lot less liquid. There's also a traditional association between liquidity and risk. So when something is more liquid, like a checking account or a savings account, you're going to have very little risk involved. In fact, bank accounts are insured by the federal government so that you don't lose your money in case a bank fails. Whereas something that's a lot less liquid is going to be really more risky. As you can see, checking accounts are the most liquid, and CDs are still quite liquid, even though they're less liquid, because you have to pay a fee to get your money out of the certificate of deposit, and so that's going to be a little harder. Investments in general, you see that bonds and stocks are a little bit more liquid than real estate, though again, traditionally less so. It'd be harder to sell a stock right away. But nowadays, again, with apps, it's a little different. But these things are still riskier because they are traditionally less liquid. And then you have real estate, which can be risky as well because certain areas are going to have housing that goes down in value, whereas you could actually make a lot of money. So real estate can go either way, but it definitely takes a long time to sell real estate that you own. So another important concept is diversification. And this is the idea that you should not invest all of your money in, say, one company, because if that company does poorly, then you lose a lot of money. Whereas if you're investing in a lot of different types of stocks or a lot of different types of investment vehicles in general, then if one does poorly, the other ones will still do well. So it'll kind of balance out, and you won't feel like you've lost a ton of money, and you won't have lost a ton of money. So that's really important to understand. So don't put all your eggs in one basket is the term, and make sure that you're spreading out your risk. When we talk about investments, we're talking about an investment portfolio. So people's portfolios are going to look different based on the goals they have. Some people are willing to be more risky, and some people not so much. If you're younger, you can probably afford to be a little more long term of an investor, and you might be able to take more risks. Whereas if you're near retirement, you probably don't want to risk your retirement money. So it just really depends. So the portfolio in general is what people's investments are, but everybody's portfolio is different. So when it comes to investment portfolios, some people are going to be more willing to take a risk than others, but it's important to understand that there is this idea that people take risk because they can make more money. So when you have an investment, whatever you make is your return on your investment, and the more that you're willing to invest in, whether it be risky stocks, the more money that could potentially be generated. An example is if there's like a startup company that is not making money right now, but could potentially be the next Amazon, it could be really cool to invest in. But a lot of startup companies fail. But then those people who invested early in Amazon, they have made a ton of money. So that's just an example. As I said, there's the return on investment, or the rate of return, and that is basically a percentage of what you've made. So it's the total return divided by how much you have invested, and that is how you get that percentage. An example of that is, so if Amanda saved $2,200 and she made $110, she would have made 5% of her original investment, which is actually pretty good and more than a money market account would normally make. But that is how you calculate the return on investment. So these are the different types of investment tools that I'm going to go over, also known as investment vehicles, and they're stocks, bonds, mutual funds, real estate, and retirement accounts. First, there's stocks, share of ownership in a company. And so a share is basically like a really, really small piece of the total company pie. But what I mean by that is you technically own part of a company, but it's going to be like one in the millionths of the company. So you are investing in that company, and as that company grows or makes more money, your share is going to be worth more, or vice versa. So when you look at your returns, the idea is to buy low and sell high, because that difference in what the stock was originally bought for and what you sell it for is that profit that you're going to make, or your return. But you can also lose money, as I mentioned. The stock exchange is where stocks are bought and sold, or at least they are traditionally. A lot of stock exchanges are virtual. They don't actually exist in a certain place, so the trades aren't actually being made in one area. But in New York, there is an actual stock exchange, and people are selling stocks and bonds and trading different types of investments. And there are stock exchanges all over the world, in Europe, in Japan, etc. But the New York Stock Exchange is where most of these large American companies are. Now, these companies are known as publicly held corporations as opposed to private businesses, which are owned by individuals or groups of individuals. Companies go public because they want to make more money, whether it be in the short term or the long term, usually the long term. And by going public and spreading out that ownership, they can raise a lot of money in order to spend on growing their business. It allows them to expand and eventually to increase their profits. Next, there's bonds, and there are a couple different types of bonds. You have corporate bonds, which is where you're lending money to a corporation in order to help it grow. And then you have municipal bonds, which are for, say, a city or a school district to raise money for public works, such as buildings or improvements upon parks, things like that. And so basically how a bond works is that you are giving a loan to the company or to the government entity, and you're getting interest for a certain fixed amount of time. And at the end, you are going to get your original investment back. And so they can be moderately risky, corporate ones, depending on how stable the corporation is. But usually not too risky. And then the government ones are not risky at all. And so you're getting a fixed return, so you know how much money that you are making. With bonds, you can sell your bonds, and so that's why they aren't super illiquid, meaning not liquid at all. So that's important to know. Following bonds is mutual funds. And this is when you basically have a combination of many different types of stocks or many different types of stocks and bonds, and they are bundled together and you can invest in them almost as one. And so the reason that people do this is because it's less risky. So there's a lower rate of return because what happens is you're diversifying really. And so as one company might do really, really well, there might be some companies in the mutual fund that don't do as well. And you can invest in a more risky fund and a less risky fund, but in general, how the companies are doing are going to even themselves out a bit. But for a long-term investment, they're really good because there is almost always growth over time. But again, they're smaller returns. And this is really good mutual funds for the beginner investor who doesn't know as much about individual stocks. And so sometimes people use investment specialists in order to help them invest, but there might be a fee involved. Lastly, there are retirement accounts, and these are usually mutual funds as well because they're not as risky. And the difference is that retirement accounts have tax benefits for people, meaning that if you wait until you're a certain age to take the money out, you might not have to pay as many taxes on that on those investments as you would if they weren't in a retirement account. But there are penalties if you take the money out early. So it's important to know when investing in a retirement account that money is not going to be there in the short term at all, but it is going to be there when you are ready to retire. A good thing about some retirement accounts are that Private employers may sometimes match what you contribute out of your paycheck, and so you can have more money in your retirement that way. So, to summarize, investments are more about building wealth than savings. And investments are good for the long term. They can be used in the short term, but there's more risk involved in that. But it's important to know that diversifying is going to make sure that you are protecting yourself from risk. And so it's also important to know that investments where you're tying up your money that are less liquid are going to come with a higher risk. Thank you very much for listening. And that is all we're going to talk about with investments today.